So if you have a market that is in contraction, it's in a box, like it's just, come down into this tight area. When it breaks out, if let's say this is all right, that's kind of an ugly 5. Okay, let's say that this is a 5-minute chart. Okay. And you see a little bit of a nudge out of the high right here. And let's say maybe you get some adoption from like this, like people trading on the 10-minute, 15-minute chart, a little bit, but then it doesn't go past that. The longest this is going to stay up here is going to be 100% controlled by the amount of people that bought and how long they're willing to hold. And so if you're looking at a 5-minute chart, and a 5-minute chart only, and you see the market comes up, but then you see it starts getting back to right here, what are you going to want to do? You bought here, you're going to want to sell, and it's going to crash back into the range. Or you're going to sell up here because you can see like it's just not getting any juice. So that's where the Ponzi scheme collapses on itself. Another way to think about this is that you have your fair market value contraction, you're in that. And you could think of that all of the activity above this is 100% always a Ponzi scheme. And the people that fuel the Ponzi scheme long term are going to be the higher time frames. So you could think of it like this might have been a 5-minute chart. And right here, you maybe got up to 15-minute adoption. But then even the 15 minutes saw that nothing's happening, and then it collapses back into the range. Then you get another one like this. And then inside here, you might have got 30-minute up to 4-hour adoption. And it hung out like this. And then all of a sudden, it goes back up. That's because even the 4-hour players, let's say it was down here for a while, and the 4-hour players even thought, okay, it's not going. It still collapses back into that origination point. And then I can't really move the screen any further, but hopefully you guys get my point here. The longer it expands and the farther it goes is 100% dependent on the higher time frames that are involved. And it's because of the nature of their round trip. If someone is looking at a 4-hour chart, if the market moved out of that contraction area like this and a 4-hour got involved, that means that they're looking at 4-hour candles, right? And it's going to take a 4-hour pattern to scare them out of the trade. Some sort of dying out, some sort of just non-committal from the market moving in their favor. They're going to do what any other trader does. They're going to close out. And when they close out, then the 4-hour holders are going to that liquidity is going to become unlocked. But keep in mind, like a 4-hour liquidity is only going to become unfixed based off of 4-hour catalysts, because that's what causes them to move. When you look at the daily chart over here, and the daily does not go above their neutral point, the last neutral point they really had, that psychological point, then anybody that was holding on to hopes of buying in this area starts selling. And that makes the collapse go. And because the nature of the catalyst is based on the daily time frame, they are waiting. The reason why this is continuing, because they're looking at other points that will correct this, like here and like here are going to be two big ones for them. Our point's going to be kind of in the middle of that. And that's why the market will gap between significant levels, because they know that it's likely going to run. They know the daily's in free space right now, and its big points are going to be down here, here, and still holding down. We have value up here. We have more intricate points than they do, but that's a point, is that the psychological threshold points are what controls the access to their liquidity and how their liquidity shifts. So going back to what Bram asked, do you hope that the higher time frame liquidity is the overall driver? I know it's the overall driver, because if it's not driving it, then all you can count on with whatever your entry time frame, your ETF, whatever it is that you're looking at, if you don't get higher time frame participation, all you can count on is this. That's all you're going to get. And it is simply because the only liquidity that is available is the liquidity involved in these shorter term swings. It is these guys trading the patterns between these highs, the highs and lows, all that. That's the only active liquidity. Everything else is locked up. Another thing that's worth mentioning in this lesson is that you might be saying like, well, what happens when like I'm looking at a 1 minute chart and it's doing this and it's going up and all of a sudden, boom, it goes like that and it moves 100 pips. What's up with that? Right? You know why? It's because there was always typically some sort of news event. Some sort of news event. And what happens in a news event is that you get all the different time frames. Here, your 1 minute, your 5 minute, 15, your hour, 4 hour, daily, weekly, monthly. All of these time frames have their eyes on price at that moment because they know the news is about to hit. That economic number, non-farm payroll, GDP, quantitative easing. If you're trading long enough, you remember that. They're all looking at that moment. And so the news event causes a massive reaction. Why? Because it activates all of the time frames all at one time. Either way, you're going to need some sort of significant pattern, a breaking of a significant high or low to start freeing up these guys one to the next, or you're going to need all eyes on one key event, and then you get the move. Either way, it unlocks liquidity on all the time frames, and that is the only way that you get a big price move. And it's just a simple fact because that fixed supply, that fixed liquidity is now available because there is a reason for it to be. Again, whether it is a news event with all eyes on the news event, short-term 1 minute traders to monthly traders where they're looking at where's this going to take the market on a macro scale, they're all looking at it and they all make decisions potentially at the same time. Or you need some sort of major technical pattern, break of major low, expansion activity. And that's what expansion is. That's what creates it. Our three market phases from contraction going into expansion is nothing more than the breaking of more and more significant highs and lows, unlocking liquidity. This naturally unlocks the liquidity. And yes, you may have some news events at key levels that go boom and causes it. Either way, at the end of the day, the only thing that drives a big price movement is to get all of the time frame classes of investors together to either cascade in on top of each other, or you get them all looking at one news event, one natural disaster, one major thing, and they all act in unison. So it's either a domino effect or it's all at once. Without that, you don't get anything. And that's why our methodology is highly dependent on understanding your higher time frame first, understanding the catalysts that are at play, understanding what news is coming up, taking that in consideration because these are the people that are going to power the move that you want.